Today I want to share with you a good example of a risk event and how we're looking for risk events that move in one direction. Now, the UK GDP print was out on April the 11th, and as this news broke, look, everything came in above markets' maximum expectations. Year on year, better than markets are expecting, month on month, the 3 month metric, industrial output, manufacturing output, services, everything was very strong. So you might have thought, oh, that's a great opportunity to buy the pound, but not necessarily. You see, the position of the Bank of England is they want to have a reason to cut interest rates, and they want to have a reason to change their short-term interest rate market expectations from having to hold like they did in their last interest rate meeting. Here you can see March the 20th, they just kept rates unchanged at 4.5%. Everyone wanting it unchanged apart from one member, Dingra, who's a renowned dove. And the hawkish Catherine Mann switched back to her sort of more hawkish stance from a surprise dovish twist she took in the previous meeting. So markets are waiting for the Bank of England just to have an excuse to sell the pound. And so that's what we're looking for today, is would the market give us that excuse? Would we see an opportunity to clearly sell the pound? And what we needed to see it coming in below market's minimum expectations. Now, as it was, look, it came in above. Now, in this particular market context, it's not a clear and obvious trading opportunity. So you can see that traders, out of the decision at 7 o'clock, this is the euro-pound pair. Now, if this was really, really great news for the pound, okay, you would expect the pound to surge higher, okay? Now, instead, what you've seen is a very tempered reaction. Similarly with the pound yen, there's a lot of yen sort of safe haven flows. If this was really great news, you'd expect the pound yen to be sort of surging higher on the data. And if you look here at 7 o'clock, okay, we see a very tepid reaction in the pound because the market didn't really know what to do with it. Does it keep buying the pound, or or does it, what does it do? So when you're trading high probability calendar risk events, just because they come in above the market's maximum expectations doesn't mean that's an automatic tradable opportunity. What you want to do is find something that is above or below market's maximum expectations, as we've got here, but is playing into a wider macro picture. And in this instance, this is a great example of how you don't just blindly trade these economic calendar events, but this is very helpful to see here on our calendar. It's above market's maximum expectation. It was instant to see that it was a really surprising print to the upside, but it just wasn't a clear trading opportunity. So I hope you've enjoyed this video about how to use high probability calendar risk events and how not all deviations are necessarily tradable. It just depends on what the market is focusing on.